it's gone from being a way of fast tracking growth to a pattern that's converted into the only way that by which people think dramatic outcomes can be achieved. And we are actually, in my opinion, just at the dawn of AECS as a category to invest in.
We have many more sandboxes that we're playing, and we're playing in investing in more geos. So we're investing in North America, Asia Pacific, and as well as Europe, and we're using that to our advantage.
When was the last time someone went to construct a home and it got done under budget or within time, right? It just doesn't happen. And I think that's the paradigm shift we are heading towards. Outcomes, but with a great deal more accountability towards those outcomes being delivered.
Yeah.
Where are we starting?
This question. So, Shub, you mentioned some figures earlier. 2019, 5 billion in construction tech. 2023, 30 billion. So that represents some explosion of funding in recent years, 4 years. It's quite a jump. But there still seems to be a lack of AEC unicorns in this space. So, Adam, I know you're super keen to answer this one. So
Yeah,
let me throw this right your way.
Super keen. I mean, to quote Mike Tyson, everyone has a plan until you get punched in the face. And so I think the market at large, certainly in the US, got punched in the face quite aggressively. You had COVID that really kind of shook up the supply chain. You have now like a rampant inflation. And if you like dig even further, the mortgage applications fell to its lowest levels since '95. I think 1% of homes traded owners in the past year. That's lowest in this, the past decade. You look at the 30-year mortgage. It's now 6 to 7%. And you have, the prevailing the commercial real estate space is, is a dumpster fire, and what led to that, huge vacancies. I think if you really kind of scope out and you look at the major hubs, the tier 1 cities, the San Franciscos, the New Yorks of the world, a lot of those like big towers are sitting vacant, 30, 50%. And, I think COVID, work from home kind of was a major factor there. But these are like major market forces that are kind of pushing against, construction, tech, or the AEC space in general. So I think, finding traction, within these prevailing very acute headwinds is always a challenge. So I think it's, I think that was, for the most part, these past couple of years, you didn't see that pronounced in the 10 years, decade prior. You were kind of in ZERP phenomenon where there was just a gushing amount of capital that was just flooding the markets. You had a very open and vibrant exit window in terms of an IPO window. So you're starting to see that playing a factor now in the deployment as well. So a lot of these factors are playing a role in the slowing down or deceleration, I guess you could say, with some respects of firms within respective sub industries in our space.
Anything too?
Look, I fully agree with what Adam said, although I guess to add, I also have a more favorable view, or let's say a silver lining kind of a view to all of this. So when we started Foundamental, so I think late 2018 or early 2019, if I recall correctly, there were a total of maybe 4 or 5 unicorns in AECS. Maybe, I think with the exception of one, perhaps all of them are from the US, right? What is really fascinating is in the last 5 years, this number has grown to about 17 or 18 unicorns. And now the spread is actually quite interesting. So just to give you a number, around 6 or 7 of these 17, 18 are from the US. So of course, US is still the leader, but interestingly, you'll notice not much has changed.
It's like 1/3, right? Yeah.
1/3. 1/3 from, let's say, 80% earlier. Just 5 years ago, US had 80% representation on unicorns. Interestingly, India is second with 5 unicorns in the AECS space. So it went from 0 to 5. China, if I'm not mistaken, went from 1 to 2. Australia has 2 unicorns and France has 1, right? So the way I see it is, and because we operate at a global level, there's an opportunity to perhaps look at what this pattern shows us and what it might be saying for the future. So the way I read this pattern is I think US has gone through, let's call it an interesting phase. Could be a phase of consolidation, could be a phase of correction, but I think it's all going for the better, which in other words, we are setting ourselves up for a more robust cohort of companies to come and take the position of the next generation of AECS unicorns from the US. Meanwhile, in other parts of the world, construction tech and AECS have become mainstream, right? So going back to our previous episode, I had mentioned that in many other parts of the world, when you brought up construction tech 5 years ago, they'd be like, what is construction tech? We don't hear that anymore because now it's become mainstream. Yeah. And I expect that to be a secular growth trend for the next few years where more and more firms will come up, more and more high quality founders will enter construction, and therefore we'll see more unicorns. So in other words, I see what we're describing as headwinds as either a zone of correction in the case of US, where it's setting up grounds for better companies to emerge, or it's just become more mainstream and it's created fertile ground for us to just multiply from here.
I certainly second that. What's the old saying from John Adams? Every problem is an opportunity in disguise, and I think you're going from 0% interest rate to inflation. I think that's now reinforcing better best practice behaviors by founders. I think it's the assumption that the gravy train was always going to be there, that money was always going to be flowing in, so I didn't really have to maybe have a critical eye of how I was running my business. So I think now this is going to have a force function of like best practices being forced within the individual organizations or these startups, which I think is going to be net positive, I think, across the field.
So Adam, you mentioned this a little bit earlier, but if we can touch on this again. So is investing in construction tech depending on global liquidity and interest rates?
Well, it's interesting, right? So private capital is more or less a lifeblood for the startup community, right? Because they're not profitable, right? They're burning more than they're raking in. So it's really dependent on the private capital allocators, be it the venture capital ecosystem, putting in capital. And so what you were finding is that there was a conveyor belt that was money in, over a few. The temporal duration was anywhere from say 8 to 10 years that you would have some exit liquidity in terms of an IPO. But then COVID and rising inflation, the market was pretty much upside down. That IPO window was effectively shut. So you had this like conveyor belt. There was just this overwhelming bottleneck of companies. So then these funds were kind of hesitant to keep deploying at their current rate because they also have LPs. And so these LPs need to have their capital back to then reallocate the funds. So you had this, this very prevailing, liquidity issue within the market. So you saw like a resurgence, people, in the space that were more or less refraining from high deployment. We actually saw that as an opportunity, whereas like you saw some individuals like within, more like generalists that came into our space, more of like tourists. Got more or less, to use the saying like Mike Tyson got punched in the face. They didn't really understand have empathy about the space, so they kind of just went to the sidelines. We saw that as an opportunity to double click and lean into the conviction of our thesis, and so like we leaned into where others leaned back, and I think that's you can see that with the fund's performance. I think that was the right call.
Yeah, I guess just to add to that, look at an extremely macro level, and if the discussion is about IPOs, large growth rounds, etc., we'd be kidding ourselves if we said it doesn't depend on the macro liquidity in the ecosystem. For sure, it is a function. But I think what is perhaps an interesting detail in the nuance is there has been a pullback in general in the venture ecosystem, or in venture funding, I guess, especially the later stage you go. But what we found is if you analyze what's been happening in the last year and a half, there's not been much of a pullback in relative terms in construction tech. Now, there could be several factors for this. One is construction tech, all things said and done, still remains, unfortunately, just a drop in the bucket as far as the overall VC activity goes. So how much deeper can you really cut down if it's a small representation? But I think we're now also seeing, or most large fund managers are seeing construction emerge as this promising new sector where it's not as fickle or as a faddy sort of space determined by specific trends, like say fintech, for example, or very other spaces which may be very specific to demands made by consumers in specific times. And it's a more evergreen sector perhaps. And I think therefore, in spite of all the volatility we have seen or the negative we have seen in the macro ecosystem, I would say construction has demonstrated itself to be a more resilient sector to back within venture and tech.
Yes, so you were touching on the point about generalists lacking empathy for real world builders.
Mm-hmm.
And that AECS is the final frontier for venture capitalists. Can you unpack that statement a little bit further?
I think if you're going to be investing into founders at the most earliest point in its journey, you should be betting on the founders have the founders should have some empathy about the customers they're going to be ultimately serving, but ultimately taking a step back, the funds need to have some empathy of understanding of how they're deploying their capital, and not using kind of overly generalist heuristics to deploy that capital and think it's cookie cutter, everything one size fits all, which is certainly not the case. And so that's something that we noticed from the jump. We were very disciplined of one, backing founders that had an increased empathy of the market that they were kind of serving and servicing, but as well as we needed to have empathy and understanding and a depth of understanding of the market participants, the different archetypes, how they're consuming products and services, versus just taking, this is what I learned in deploying capital in say, direct to consumers, and then having that, that kind of failed logic that there was going to be applied to, this industry as well, which was, looking back, hindsight's 2020, but I think that was just really just a failed logic, across the board with a lot of these funds.
I mean, look, since we are talking about patterns, and because I also have the pleasure of having Adam with me on this conversation, so in my mind, the way I also think of it is, look, we have a lot to thank Silicon Valley and the US venture ecosystem for how VC as a profession, of how technology investing, et cetera, has evolved over the last, say, 30, 40, 50 years. And that has, of course, also shaped how startups approach their growth journey in using capital smartly to dramatically speed up growth. But I think it's also resulted in a pattern where it's gone from being a way of fast-tracking growth to a pattern that's converted into the only way that by which people think dramatic outcomes can be achieved. As in, for example, if you need to scale fast, you need to be a software business, right? Yes. Or you need to very visibly demonstrate the effects of being a technology-led business or a technology-enabled business from day one, and do all the things that come with it in terms of how you monetize products and services and whatnot, and use that to either drive a burn or determine your fundraising decisions. I think what is actually quite different about AECS as an industry is we are actually, in my opinion, just at the dawn of AECS as a category to invest in. And therefore, it's inappropriate to just completely inherit these learnings over the last 40, 50 years and take them for granted as the way the first generation of winning companies in AECS, that they will be funded and incorporated in this manner. I think they'll be very different. So in so many ways, we're actually in the process of shaping and writing that playbook. Of course, we will learn our lessons from what's already happened in the venture ecosystem, but this is going to be a new playbook. It's not a continuation of a playbook that already exists. Yeah. And I think that's part of what I think generalist VCs perhaps take for granted or get wrong, and even many founders take for granted and get wrong.
Yeah. Yeah, and I think to refine a playbook, you need if you look at just training models, you need more data to train. I think what lends our fund as an unfair advantage and strategy, I think is proven to be more or less correct, is some of these funds are just playing in one proverbial sandbox, training their data set and understanding of the market, what business models ultimately work. What works for us is that we have many more sandboxes that we're playing, and we're playing investing in more geos. So we're investing in North America, Asia Pacific, and as well as Europe, and we're using that to our advantage. That's like reinforcing, refining our understanding of the market participants, and ultimately what solutions, playbooks find root and grow in some regions versus others. And that, I think, puts us up a step further and a step ahead than your average bear, or your average fund, your average journalist, and certainly I think, in my opinion, it's better and more successful than your other strategics that are trying to operating in our space. I think they're more or less floundering, but that's kind of more of a juicy take. But
I think the 2024 saying is FAFO, F-A-F-O. Fuck around, find out.
Oh, nice.
That's yours approach.
Yeah.
I want to touch on, so in other industry we have product or service, and we have funding, and there is the outcome is an app platform which delivers intangible product or service. And construction is very tangible and outcome driven. So we want to see outcomes of when the money is injected or there's investment in the service or product. Do you see any pattern there? Is construction tech going to be following other industries, or staying on its course, being an outcome-driven industry?
So I feel for most of construction, at least in the near to medium term, and let's say for the sake of this discussion, that means the next 5 to 10 years, I expect it to be a more outcome-driven, or continue to be an outcome-driven business, with the difference that I think when it comes to status quo, quite often just the outcome happening eventually is taken for granted as a valid outcome, right? Whereas I think what we are moving towards is a situation where the outcome happening by itself is not enough or not considered satisfactory. The outcome happening within a certain budget and within a certain amount of time, or within the schedule, consistently is going to be the new expectation. Now, some of our viewers and listeners watching this may be like, hey, what's the big deal with saying that? I mean, for instance, when you order food, you expect it within a certain amount of time. Is that such a big insight? It may not seem like such a big insight, but when was the last time a public works infrastructure got done in the time that was originally announced for, right? Or within the budget that it was announced for? When was the last time someone went to construct a home and it got done under budget or within time, right? It just doesn't happen. And I think that's the paradigm shift we are heading towards. Outcomes, but with a great deal more accountability towards those outcomes being delivered.
Yeah, that sounds like this productization, right? Because you kind of can expect the product, which is the home, for example, in a certain time, rather than over budget and over time. Yeah.
So you need to be careful with throwing around the word productization with VCs. I think a lot of generalist VCs, when they hear you say that, they'll be like, oh, you know what? So Martin is thinking of slapping on a software layer on top of this outcome. But I actually I'm in agreement with what you said. My interpretation of what you said is you're standardizing the output and the outcome in a way that it can be repeatedly delivered in a consistent manner, which may or may not involve a piece of software doing it.
Yeah. My brain's going back to the empathy question. I think that's something that can be overstated of value, and if you really kind of taking a step back of what's in the news. You see Boeing, with this repeated issues. If you look at the CEO, I mean, he's an accountant at trade. So I think as I mentioned, as a more of like a funny reaction, Mike Tyson's, everyone's got a plan until you get punched in the face. I think that's like very pronounced when you're a founder, when you're just starting off and you don't have a real true understanding or empathy to the individuals, the stakeholders you're going to be serving, because you will end up getting punched in the face, right? It's not always up and to the right. There's always peaks and troughs. And then what this market really showed us is like there's a new trade wind, and that those founders who ultimately lived to fight another day is like they were able to tack. They were able to see that there was a new trade wind, tack the proverbial boats and take advantage of that and harness that new wind, right? Others were floundering because they didn't really have a true understanding or empathy within the space that they were ultimately creating their firm in.
Feels like we're touching nicely upon maybe some future trends within the AECS space. We don't have to dive too deeply, but where do we think some of the most, I don't like using this word in construction, but disruptive technologies or trends will have the biggest impact in AECS over the next few years?
AI.
I mean, yeah, certainly AI. I mean, that's it's certainly a topic that's been over discussed and unpacked quite a lot. I would, before we go in that direction or sprint in that direction, because at some points it's like you're sprinting in a dust storm. I certainly there's a lot of value that these AI applications certainly lend and offer their intended ICPs. What I think excites me, maybe us, as well as like really focused on deep tissued or very large market trends. And so what we kind of noticed in the early days was, at least in the States, there was a labor issue. If you really kind of cast the Eye of Sauron out within 2030, a large swath of the labor force is going to be retired. And then you kind of we dug a little bit further and like, well, the younger demographics that should be replenishing and replacing these retirees are non-existent. So we were just kind of like, well, man, that's a very bleak future. We're going to be creating the most complex buildings with the least experienced individuals. So how do we correct that? Chasing firms that would, in a sense, be building these new on-ramps to maybe pirouette around that very bleak future. So maybe the upskilling, skilling, maybe robotics, taking out humans from very repetitive, dangerous workflow steps was certainly an area that remains to be an interest for us today. Certainly in COVID, I think again the industry got hit in the face with the supply chain. It became very volatile, lead times, prices. So we saw that was the response there is like now the demand sides are going to be trying to reinforce their supply chain a little bit more and maybe looking at U.S.'s southern neighbor as a new trade route. So how do you find solutions that can maybe enable those demand side users in the States to identify, discover high quality, low cost building materials or products, and then as well as distribution, how are you moving those goods? So you have to move those goods from your southern neighbors up north, and logistics and supply chain certainly falls within that camp. Another one would be the grid. I think in general, I think you're first to spot this as well, and we dug in further. I mean, at least in the States, I think broadly, I think the energy crisis I think is going to be very interesting to see how each market responds. Electrification of everything. That certainly is going to be demand on the grid. There's data centers. He rightfully called, I think, before anyone else. There's a new resurgence. If you really look at the demand pool, the energy pool from the data centers, it was about 4 or 5% of the grid. They're projecting this to be now about 20 to 25%.
Wow.
So that's
5x.
an alarming amount, right? So how do you get around that? You're right. There's going to be new infrastructure that needs to come into play. So I think that's going to be a huge trend that a lot of people are going to be talking about in the near future.
I mean, I'm actually really excited to discuss this in a more specific context in how it affects incumbents in a future episode. I guess we're all doing together. I guess for the purpose of this discussion, what I would say is I think the first generation of disruptors, which by the way, they're already well on their way to occupying that place, I think are firms that on the surface don't seem like they're doing anything disruptive. They're just somewhat better versions of what incumbents are doing on the supply chain side. But the outcomes they're able to deliver and the rate at which these outcomes are happening in financial terms as well as in terms of the difference they're making to the supply chains, that is, I think, transformative. And what I'm thinking, just to put a little bit more context here, is supply chain firms like Inframarket, for example, which is our portfolio firm. I think, and as a next set of disruptors, what I personally am very excited about for the next 5 years is firms that disrupt the services layer of construction, probably with the use of AI and especially generative AI.
Service like B2C or B2B still?
So that is interesting, right? So in construction, there's actually services embedded all over the value chain at every stage, which we often either take for granted or we underestimate. So for example, if we were to design this building we're in, it didn't happen as a result of someone designing it on a piece of software. Someone offered consulting services to do a feasibility analysis, conceptualization, engineering, all these are services, right? Why can't some or a significant chunk of it be done with AI, harnessing the collective power of all the composite knowledge we've collected, or the wisdom of all these individuals? Why can't the wisdom be funneled into an AI, right? I think, in my opinion, that's a very powerful vision, and I'm very, very excited to look into opportunities like that. And I think that truly has disruptive potential in the way it affects the role of a knowledge worker, how services are seen, and how a lot of these hidden but large cost items in construction, how they could be eliminated to make this industry better.
Yeah, that's extremely well articulated. Taking a step further, if you look at who's going to be disrupted, it's like there's almost these consultants, right? I'm hiring these outside consultants. What you find there is they're very costly. They run a very timely, process. So if you're effectively able to now provide a software solution for those developers that were essentially, instead of hiring your consultants, I'm going to essentially enable, the project through a tech-enabled service. What do I get? I get to retain all that knowledge. I get to, in effect, effectuate that project cheaply, as well as be able to collapse and condense that time to completion. So my project success is not weighing on these exorbitant fees that I'm also paying to these consultants. So I think you're almost, if you're going to bet on something, like a very provocative bet, I think consultants are going to be like, it's either the consultants or go the way of like the brokers within the freight. It's either you're going to lean into a lot of these tech-enabled solutions, or you're just going to evaporate and get scattered to the wind.
Sounds like they're trying to kick us out from our day-to-day jobs, which I completely agree will have to happen.
Or help you graduate to a higher degree.
Exactly.
Yes.
Where you're masters of AI.
But what is interesting, like you guys now mentioned, so sounds like productization of it, what you just described, I think this is productization, because if the person who is going to if we normally would employ architect, engineer, other consultants to get it done, if they can do it off the platform somehow, without using heavily these consultants, that's a lot of saving for them. So that's a customer, right? Who can, so the software startup or a company can serve the customer rather than the architect, engineer, and then it goes to the customer, right?
Yes.
So that's kind of the productization that I'm thinking of, and this B2C, getting into more B2C type of services within construction. Yeah. That was it.
So, impact of macro events. Trib, you touched on some points earlier. How does Foundamental take into some of the significant macro events the last 5 years or so have been? I mean, we don't need to repeat it, but wars, recessions, pandemics, insert any word here kind of thing. How do you guys deal with that? I guess there's only so much you can predict and foresee, but you have to deal with what can happen externally too.
I mean, look, my first reaction to that is firstly to stay humble and not assume that we can, you're fully in control of everything, that are fully aware of what is around us today or what may come in the future. In general, the best investment decisions are those which are not overly dependent on some macro that is currently taking place or is likely to take place. Hopefully, it is a decision which will perform very well regardless of what happens in the future. Yeah, it may do a little bit better if a few things work in our favor, but in general, I mean, I at least as an individual wouldn't like to bake my investment decision based on certain macro events or things that are happening in the short term or which have just taken place. Hopefully it's a secular trend that is only going in one direction, and there is no enormous assumption needed on my end to assume that would be the case. Yeah, I mean, so not to, I guess, trivialize the question, but I would say for anyone reading, and this is my personal investing style, and I think there's several styles that can be accommodated, it is to take inventory of some macro events, or at least the baseline and a trend, but not overly index on that. That's my personal style.
Yeah, well said.
All right. Should we wrap it up?
Any advice for founders or investors operating based on the patterns that you're seeing that you could give, and how could they build a great company with what's happened previously?
Everyone has a plan until you get
Yes.
punched in the face.
Everyone has a plan until you get punched in the face. Yeah, I think those are very, those good, cautionary words to live by. But I think if there's any like prevailing advice that we've been kind of advocating and breathing towards our founders within our portfolio, or the ones that we were just meeting, I think it's just being a little bit having a higher degree of governance, best practices. I believe that constraint breeds creativity. So in abundance, you saw just growth for the sake of growth that kind of led to a lot of pronounced issues. So I think it forces, if the founders have, I think the current market trends, these market forces, I think are going to be net beneficiary for the long run to the funds that are investing, is certainly the employees that are working at these firms. So I think the founders are going to have a healthy dose of greater degree of governance, how I'm running the business. I'm going to be running my business a little bit light, not spending cash just to spend cash, because hey, those funds are going to continue to fund my exploration events. So yeah, I think that would be my take. I don't know if you.
Yeah, so I fully agree with that. I think just to add, since this discussion is about patterns, I think it's also important not to base your decision in its entirety, either as an investor or as a founder, on small samples of patterns observed and use that to extrapolate the whole thing. I mean, one thing that comes to mind, I mean, quite anecdotally, because I literally read about it on the way to the office this morning. And I don't know if it's an appropriate discussion topic, but I'll bring it up nevertheless. So I was reading that Meta's image AI engine. So typically when you query it for an Indian male, it shows up gents with turbans, right? Which is interesting considering, that only signifies 1 to 2% of the population, and yet that is what the engine shows, because the engine has been trained on that sample set. Right? So I guess what I'm saying is, make sure if you choose to train your decision or base your decision on a sample of patterns, that you don't come with a sampling bias.
Yeah, well
you
said.
take in a composite pattern, or give yourself as much of a chance for a true representation of reality or where the market is heading.
Brilliant.
Good way to close. Okay, so next episode we'll be discussing fallacies with Patrick and Adam. Shub, I'm sure you'll be sad to be missing out on this one.
Very sad.
We'll be discussing why the world does not need another generic VC.
Oh, nice.
Oh yeah.
And diving into some of
that'd be
the
fun.
That'd be juicy.
diving into some of the shortcomings of the generic VC model.
Yeah, I look forward to it.
Looking forward to it. Thanks,
Excellent.
guys.
Thanks,
Thank you.
James.
Thank you.
Thank you.